what we're going to be going over here are diluted earnings per share with multiple convertible securities, and we're going to go through a step-by-step process here to determine the diluted earnings per share. But before we get into our step-by-step process here, let's just understand what those earnings per share is here. So that would be our net income here for the year divided by the average number of common stock shares outstanding. But when we have these convertible securities, we have to make some adjustments here to our net income in the numerator here, and also the number of shares that are outstanding here in the denominator here. So let's first look at our numerator here, and this is the case we're going to assume the conversion to common stock for this convertible security as of the beginning of the year here. And we'll first look at we have to determine this incremental numerator effect for the earnings per share here. Okay, so what we're going to do is we're going to start out with our net income here for the year, but remember this net income, that's as of the end of the year here, and it's affected by those convertible securities here. So let's just go through the basic convertible securities that we'd be looking at here. So first, for stock options and warrants, well, there would be no effect here to the net income. There wouldn't be any effect here in the net income. But when we're talking about convertible bonds here and convertible preferred stock, it affects our net income here. So for our convertible preferred stock, we would have paid no dividend here for the year here. So what we would have to do is add that dividend back here in our numerator, because it would have been at the end of the year here, that net income would have been reduced by the dividend that was paid here. But in the case here where they're convertible in the beginning, we have to add that dividend back here to adjust our net income here. And then the same for our convertible bonds here. We would have had some interest expense that would have been subtracted from our net income, but since they were converted in the beginning of the year here, we have to add that interest expense back here. But when we're talking about bond interest expense, it's added back net of taxes. Whereas with the preferred stock, the dividend here didn't involve any taxes. There wasn't any tax deductibility on it, so we just add back that dividend. And then when we come down to our denominator here, well, we have to know what our average common shares are outstanding. But because these securities were converted here, we have to include those here for the total number of shares that would be outstanding when we say they were converted here into common stock. So this is where we have to determine that incremental denominator effect here for our earnings per share. And it's easy enough to do here for the preferred stock and preferred stock and our bonds, because there's some conversion ratio based on what it is, what the conversion ratio is, or the number of bonds or preferred stock that can be converted into common shares, or common shares of stock exchange for those common shares. But just to point out here, when we're dealing with options and warrants here, we just can't take the total number of options or warrants that could be converted. We have to use this formula here, and I'm just showing it here, to determine the number of converted shares. That would be the market price minus option price divided by market price times the number of options. That equals the number of shares that are converted. Just for stock options and warrants, you have to go through this extra calculation here to determine the number of shares that are converted. Okay, so let's move down here. So first, step one here, we have to determine for each of the securities here this earnings per share effect here based on the incremental numerator effect. That's how our numerator, or how our net income has changed for the year here, and also our incremental denominator effect. That's what affects the number of shares that are common stock that would be outstanding. That would be added to the average number of shares of common stock outstanding. And we have to determine that for each security here. So we're going to come up with the dollar per share here, this earnings per share effect here based on the change here. Well, how our net income for the year is affected by those convertible securities, assuming that they were converted here at the beginning of the year here. And then we have to look at the number of how our shares outstanding in common stock were affected here based on the conversion of that security here. So first off, we're going to be going through 4 securities here for this first step one here. We're going to have some stock options, and those could also be stock warrants. We're going to have 2 different bonds, and we're going to have some preferable stock that we have to that would be included in these convertible securities. So again, in each case here, we have to determine how our numerator was affected here and the denominator affected in that earnings per share. Numerator would affect the net income for the year here, denominator number of shares outstanding. So for stock options, let's just say we had 50,000 of them here. Market price $30, option price $20. Well, we went through that before here. When you're working with stock options and warrants, there's no effect here to the numerator in our earnings per share equation, but our denominator is affected here. And in this, based on this example, we're going to increase it here by 16,667 shares. Additional shares that is going to go into our denominator in addition to the average number of shares of common stock outstanding. And we just use that equation here. Market price per share, and this was the option price divided by market price here, times the number of options outstanding. That equals that denominator effect here. So for our stock options, we calculated that. Now let's just move down to our bond here. Just say we had 2.5 million outstanding of their 8% bonds, and they were converted into 100,000 shares of common stock. So our numerator effect, that's simply going to be that tax that we're going to have to add back to our net income for the year here, less the 1 minus the tax rate. So that's the key here when you're working with those convertible bonds. You have to subtract out the tax that would have to be added back, because the bond would have been converted at the beginning of the year, and we would have avoided that tax. So we just take 2.5 million, 8% here times 1 minus the tax rate. That's going to give us $120,000 here in interest that has to be added back to our net income, because that bonds were converted at the beginning of the year. We avoided that interest, so we added back. And then the denominator effect, let's just say that bonds were converted into 100,000 shares of common stock. So what we get here, numerator divided by denominator effect, we're going to get $1.20 here per share based on that earnings per share effect here. Okay, so let's move up here further to our next we're going to have another bond here, same thing, 2.5 million, it's 10% converted into 100,000 shares, go through the same thing here. Interest expense here times 1 minus the tax rate, and that is equal to 150,000. So we avoided that amount of interest, added back to our net income here. So our numerator effect is that 150,000 in that earnings per share here. Denominator effect, let's just say there was, on our conversion ratio, there was 100,000 additional shares here of common stock issued based on the conversion of those bonds. But what we want to look at here is this earnings per share effect here, and that is $1.50 per share. Okay, and then finally, just moving down to some preferred stocks, just say we got 25,000 shares, and just say the dividend is $10 per share. Again, they're converted into 100,000 shares here, common stock. So our dividend here, 25,000, $10 per share, is going to be $250,000 in dividend here. Again, looking at our numerator effect here, we would be adding, since that dividend would have been reducing our net income, we have to add it back here. As of the beginning of the year, we would have avoided that dividend here by $250,000. So that's our numerator effect. That would be added back to our net income. And then for the denominator, let's just say again that was converted into 100,000 shares here, common stock. So here's our earnings per share effect here, $2.50 per share. Okay, so we went through. Okay, so let's go down to step 2 here. We went through to determine that earnings per share effect here for each of our convertible securities here, and this is where we have step 2 is where we have to rank the earnings per share effect from the smallest to the largest amount here. So that's why we went through and we determine the effect here per share for each of these securities. So for our stock options, we would have had a 0 effect here on earnings per share, and 8% convertible bonds, $1.20, 10% convertible bonds, $1.50 here per share, and then our convertible preferred stock was $2.50 per share. So here we had to rank our securities. However they fell out here, we have to rank them from the smallest effect here up to the largest effect. So based on this rank here, we recompute the earnings per share. So that's what we had to do here. We had to first determine the effect on the earnings per share, then we had to rank these earnings per share here, and now we can go down to step 3 here. So this is where we're going to recompute the earnings per share to determine the diluted earnings per share here. So based on our ranking here, I got them showing here. So for our stock option, we're going to set up a table here to determine the diluted earnings per share here. And first off, we set it up here based on our ranking. So for our stock options here, our lowest rank here, that would be the first one that we're going to work for, our diluted earnings per share. And then bond, 8% bond was the next one here, $1.20, and then the 10% bond at $1.50 here was, and then we have our diluted for our preferred stock here at $2.50. So what we have to do is we have to determine the earnings per share here. So that's really the net income here for the year here divided by the total shares of common stock outstanding after the conversion here. So our net income, let's just say here, let's look at our options. We started out with $1.5 million, and then nothing, our numerator, nothing was affected by for these options here for our net income. So we just end up our total numerator, we look at it, $1.5 million here. So common stock outstanding, we just say was 500,000, and then our incremental denominator effect here. So we have what we're going to end up, we have to determine the total in our denominator, total equivalent common stocks outstanding. So we have started out with 500,000, and then that denominator, we would have, because of those options, we would have issued 16,667 shares of stock. So that increases the total number of shares outstanding here up to 516,667. So simply for our, we are recomputed earnings per share here, we have at $2.90. Simply the 500,000 here, well, it's the 516,000 shares outstanding, and you divide that into your total numerator, your total net income plus the whatever. There was no change here to the net income, so it was 1,500,000. You come up with $2.90 per share. Okay, so next thing. This is the key here. This is how we work it. We actually do one builds on the other. So for our 8% bond here, our numerator, we take that from the previous security that we converted. That was that lowest one here for our options. So our numerator for the previous one, 1.5 million, or well, yeah, that was our total numerator, 1.5 million here. So then we would add in that effect, that numerator effect here. That was that, in this case, it was the interest avoided here. So add that to the what we got our previous numerator here from our options. We're going to get our total numerator here of $1,620,000 here. So that's for the 8% bond, and you can see how it worked off our options here. We have to take what we had from our options here, the previous amount, and then what we avoided here in interest, we had to add that to it to come up with our total numerator here. So same thing goes for our denominator here. We're going to work off the previous amount here, that 516,667, and then we would add to it the number of shares that were converted for this 8% bond, let's just say 100,000. So our total denominator here comes up to 616,667 shares here that are outstanding. So divide that by our total numerator here that was adjusted for that interest expense here, 1,620,000, by that 616,067, and we're going to get the recomputed earnings per share here at $2.63. So you can see it was diluted here. We started out with $2.90 with the options, and then with the 8% bond we got up to $2.63. So it's dilutive here. Since it's gone down in value, it's dilutive. Now, just working off our 10% bonds, we don't have to go through all these numbers. We start out with our numerator, previous numerator here from the 8% bonds at 1,620,000 here. Then we add that in this case the interest that was avoided, 150,000. We come up with the total numerator here, in this case 1,770,000, and then we take the denominator from the previous amount here, that was that 8% bond. We move that up here, so we start out with that here in our denominator, 616,667, and then we add to it the number of shares that were converted. That was that effect here in the denominator effect here based on converting those 10% bonds over. Again, let's just say it was that 100,000 shares here, so we come up with our total denominator here for the 10% bond at 716,667. So you see the pattern that's going on here, and then their recomputed earnings per share, $2.47. Simply the total numerator here, that's that adjusted net income here for the year here, based on what we're bringing in from our 8% bond. You divide that by the total denominator here. Those are those adjusted common shares here that were converted, and that was brought over from the we use that previous amount here coming in from the 8% bonds, so we get $2.47 per share here. So you can see again it's it's dilutive here. We moved down from $2.63 down to $2.47, and then for a preferred stock, we just take our previous total numerator here from the 10% bonds here, 1,770,000. Add to it that avoided, in this case it was the avoided dividend that had to be paid at $250,000. So we come up with our total numerator. That's the adjusted net income of $2,020,000 here, and then we take the previous denominator here, that was at $716,667 from our 10% bond, and then we would add it to the number of shares converted here. That's that effect here, the change in our denominator here for those preferred stocks. Let's just say 100,000 here again, and we come up with our total denominator here of 816,667 shares here. So just looking at our total numerator, which is our adjusted net income here, 2,020,000 here, you divide it by the total denominator, that's that adjusted common shares outstanding, and you're going to get $2.47 per share. But in this case, you can see it's going to actually be what they call anti-dilutive, because we didn't have any decrease in our recomputed or diluted earnings per share here from our 10% bond. It was at $2.47 per share, but our preferred stock was $2.47 per share. So in any case here, if you inflate your earnings per share here when you're doing your calculation, then you would not include that particular security in your diluted earnings per share here. That would be thrown out. And in this case, since our preferred stock, it's a technical matter here, but since it didn't really inflate, but it didn't deflate or didn't reduce the earnings per share here, for diluted earnings per share, we wouldn't include that preferred stock here. So it would be considered anti-dilutive, and it would have been excluded from our earnings per share. But you can see what's going on here. We had to first go out and determine the change. If we got our change here in our net income, or the numerator effect here in that diluted in our earnings per share effect, and we had to determine the denominator effect in each case here for those securities. So the additional securities or additional number of common stocks that would be outstanding, and then based on that we recomputed the earnings per share for each one of these securities, and then each one of them built off each other here. We had to use the previous numerator that we had from the previous security, and we had to take the previous denominator from each of the previous securities, and then we had to add the effect for that particular security, how it would affect the numerator or net income. And in the case here of bonds and bond interest and bond dividends, it would have been avoided, so we've increased our numerator or net income based on a conversion, and then also for the number of shares that were converted here based on however that worked out for our various securities. We would start with our denominator from our previous security that we calculated and add to it the number of shares that would have been converted or increased it. So then we come up with our total denominator, and then we can look at our recomputed earnings per share. Be looking at our total numerator here divided by the total denominator. Total numerator would have been our net income that was adjusted here for that particular securities, and then the denominator is starting with our average common stock and whatever shares that were increasing it. So that would be it, and this divide everything out, and you come up with your recomputed earnings per share. And just remember, you have to use this ranking system. We have to start with the lowest ranked security that had the least effect on the earnings per share here, and then we worked our way across here to the one that had the highest ranking on their earnings per share here, and then we went through those calculations. So this is just a good example here of how that would work, and companies use that here when they have to calculate their earnings per share here. They have to use this three-step procedure here where you have to determine an earnings per share effect for the particular security here, and then you have to go on to determine, rank those earnings that earnings per share effect, and then you have to go and you have to recompute the earnings per share effect based on that ranking.